I need to tell you something I have been sitting on for 3 months. I sat in a room in Zurich with 11 people who manage more than $400 billion combined. I asked them one question. I said, "Where is the money going?" Every single one of them gave me the same answer without hesitation. They said, "Away from dollars, away from U.S. assets, away quietly, carefully, and fast." And here is why I cannot stay silent anymore. What they described is already happening to your money right now. Not next year, not after the next election. Right now, today, while you are watching this video. I spent 22 days in Zurich, Singapore, and Dubai meeting the people whose entire job is to move capital across borders before the rest of the world figures out what is happening. And what I am about to show you has a direct consequence for every single dollar sitting in your bank account, your 401k, your brokerage account, and your savings right now. This is not something most financial advisors will tell you. Most financial advisors have never sat in those rooms. Most of them have never asked that question. Most of them have never seen the answer I am about to show you. Stay with me through every single minute of this video, because at the halfway point, I am going to reveal the one number I saw on a screen in Singapore that changed what I personally did with my own money the moment I landed back home. Do not skip ahead. What I show you first makes the halfway revelation land with the full force it deserves. Subscribe right now. You do not want to miss what comes next. Let me start with the moment that changed everything for me on this trip. I was sitting in a private conference room on the 14th floor of a building overlooking Lake Geneva. The room had no windows facing the street. The people in that room do not need windows. They see everything from the numbers on their screens. There were 11 of them, portfolio managers, capital allocators, the people who decide where pension funds and sovereign wealth funds move their money, not retail investors, not commentators, the people who actually move the money. I asked them a direct question. I said, "Do you believe the US dollar will hold its position as the world's reserve currency for the next 20 years?" Every single person in that room answered the same way. Not one of them said yes without qualification. Not one. Several of them shook their heads before I even finished the sentence. One of them, a man who has been doing this for 38 years, looked at me and said, "The question is no longer if. The question is how fast." I wrote that down. I wrote it down because I have been in rooms like that before. I have seen what happens when the smartest people in the room stop debating whether something will happen and start debating the speed. That shift in framing is the signal. I have seen it before. I saw it in 1999 before the dot-com crash. I saw it in 2006 before the housing collapse, and I am seeing it again right now. Then I flew to Singapore. I asked the same question to a different group of people. Capital managers who work across Asia, people whose job is to track where the world's money is flowing. And I got the same answer. Not the same words, but the same answer. And that is the part nobody is talking about. Before I go any further, I want to tell you something I have never said publicly before. I want to tell you about the worst financial mistake of my life, because it is directly connected to what I am warning you about today, and because I think you deserve to know that I am not standing here as someone who always got it right. I got it very wrong once. It was 1987. I was 34 years old. I had a wife and 2 young children who depended on me. I had spent 4 years building a position that I was certain was correct. I was certain the market was going to move in one specific direction. I had borrowed $42,000, some of it from my father, some of it from a line of credit I had no business taking out. I was so confident that I did not hedge. I did not diversify. I did not protect myself. I just held the position because I was certain. And then on one Tuesday morning in October, the market moved in exactly the opposite direction. In one day, I lost more than I had made in the previous 2 years. I had to call my father and tell him I had lost his money. That is a call I never want to make again. I sat in my car for 2 hours before I could go home and look my wife in the eye. That failure taught me the most important lesson of my entire career. I learned that the most dangerous financial events in history never feel dangerous when they are happening. They feel like certainty. They feel like confidence. They feel like everything is under control. And that is exactly the feeling I am watching spread through the financial system right now. The certainty that the US dollar will always be the world's reserve currency. TH. Certainty that US stocks will always outperform. The certainty that the system we have had since 1971 will simply continue forever. That certainty is what frightens me most. Now let me show you exactly what is happening with the US dollar and where your money has already gone. And here is the revelation I promised you at the halfway point. I said publicly 18 months ago that the US dollar was beginning to lose its reserve currency premium. I said that this process would be slow at first and then sudden. I want to show you the numbers that prove this is not a theory anymore. It is already happening. The US dollar currently makes up about 58% of global foreign exchange reserves. That sounds like a lot, but in 1999, that number was 71%. Think about what that means. In 25 years, the dollar's share of global reserves dropped by 13 percentage points. That is not a small shift. That is a structural change that has been happening quietly while most people were watching the stock market go up. Now here is the number I saw on a screen in Singapore that stopped me cold. The S&P 500 is currently trading at approximately 35 times earnings. 35 times. The historical average going back 100 years is about 16 times earnings. That means U.S. stocks are trading at more than double their long-term average. The last time we saw valuations at this level was the peak of the dot-com bubble in the year 2000. Goldman Sachs has projected that the S&P 500 will return approximately 3% per year over the next decade when adjusted for inflation. 3% per year for 10 years. Now compare that to what the rest of the world is trading at. Emerging market stocks are trading at approximately 12 to 15 times earnings. European stocks are trading at about 13 to 14 times earnings. Same company earnings. Same global economy. But priced at less than half what U.S. stocks cost. That gap has never been this wide for this long. And here is what that means for you. If you have a standard retirement account in the United States, there is a very good chance that 80% or more of your money is sitting in U.S. assets, U.S. stocks, U.S. bonds, U.S. dollars, and all three of those asset classes are priced for a future that may not arrive. That is not my prediction. That is the projection of some of the largest financial institutions in the world. The people I sat with in Zurich and Singapore are not predicting this. They are already repositioning because of it. And that is the gap between what powerful people know and what you are being told. Now I want you to feel the weight of this number before I tell you what to do. I want to put it in historical context, because this is not the first time a dominant currency has started to slip. And every single time it has happened before, the people who understood the mechanism kept their wealth. The people who ignored it lost theirs. Let me take you back 500 years of history. Let me start with the Dutch Empire. In the 1600s, the Dutch guilder was the world's reserve currency. The Dutch East India Company was the most powerful company in the world. Dutch bonds were considered the safest investment on earth. Everyone wanted to hold Dutch assets. And then over the course of about 60 years, that dominance faded. It did not happen in a single crash. It happened slowly. Then suddenly, the people who held guilders while the British pound rose kept losing. The people who moved early kept their wealth. Then the British pound took over. For more than 200 years, the pound was the world's reserve currency. The British Empire was the most powerful force in global trade. And then came 1956, the Suez Crisis. Britain tried to use military force to protect its economic interests. The United States told Britain to stand down, and Britain had no choice but to listen, because Britain needed US dollars to survive. That moment, that single moment in 1956, marked the end of the British pound as the world's reserve currency. Not because of inflation, not because of a market crash, because of power, because the country that held the debt had more power than the country that owed it. In the 10 years after 1956, the pound lost more than 30% of its purchasing power. British citizens who held pounds watched their savings shrink. The people who had moved into gold and dollar-denominated assets before that moment kept their wealth. Now here is the one that hits closest to home. In 1971, President Nixon ended the direct convertibility of the US dollar to gold. Before that moment, every dollar was backed by gold. After that moment, it was backed by nothing except the promise of the United States government and the military and economic power of the United States to enforce that promise. In the 10 years after 1971, gold went from $35 an ounce to $850 an ounce. That is a gain of more than 2,000% in 10 years. Your savings account during that same period earned maybe 4% per year. Gold rose 65% in a single year in 1979. In real purchasing power, the people who held only dollars in savings accounts lost more than 60% of their wealth relative to gold. The number in their account went up, but what that number could buy went down dramatically. That is not a market crash. That is something quieter and more dangerous. That is the slow shrinking of what your money can buy, and it is happening again right now. Now let me show you the present-day evidence, because I know some of you are thinking, this is history, this is old. Let me tell you what is happening right now in 2024 and 2025. Central banks around the world bought more gold in 2022 and 2023 than in any 2-year period in the past 50 years. Not retail investors, not hedge funds, central banks, the people who manage the official reserves of entire countries. They bought more gold last year than at any point since 1967. Why? Because they are doing exactly what I just described. They are quietly reducing their exposure to US dollar assets and moving into something that cannot be printed. China reduced its holdings of U.S. Treasury bonds from over $1 trillion to under $770 billion in the past 3 years. That is more than $230 billion moved out of U.S. government debt. Japan has been selling U.S. treasuries as well. Saudi Arabia has started accepting payment for oil in currencies other than the U.S. dollar. The petrodollar system that has underpinned U.S. dollar dominance since 1973 is showing its first real cracks in 50 years. And what has this done to gold? Gold has risen more than 80% in the past 3 years. Not 5%, not 10%, 80%. While your savings account was earning between 2 and 5% per year, gold was rising at a rate that made those returns look like standing still. Now translate this into your wallet. The average American grocery bill has increased by more than 25% since 2020. Your purchasing power, meaning what your dollar can actually buy at the store, has dropped by more than 17% in 5 years. The number in your account looks the same or slightly higher, but the world that number can access has gotten dramatically smaller. That is not bad luck. That is not inflation being transitory. That is the predictable result of printing more dollars than the economy can absorb. And it is the same mechanism that played out in 1971. The same mechanism that played out in Weimar Germany in 1923 when the German mark became worthless. The same mechanism that has played out in every reserve currency transition in 500 years of modern history. The people who are making decisions with their own money right now are not waiting to see how this ends. They are already moving. And that is the part nobody is talking about. They are making different decisions with their own money than the advice they give publicly. I want to pause here and say something directly to you. I am not here to frighten you. I have been through cycles like this before. I have watched empires rise and fall in economic terms. I have seen currencies lose their dominance. And I want you to know something important. The people who prepare for these transitions do not lose their wealth. They protect it. They move it into things that hold value across currency transitions. They diversify away from the single point of failure. They do what the large institutions are doing quietly right now, but they do it before the window closes. And the window is closing. Not in decades, not in years. The first visible cracks are already here. The move is happening right now. And you have a decision to make. This is the most important financial decision I have ever asked you to consider in my 35 years of watching these cycles. So now let me tell you exactly what to do. Now let me tell you exactly what I personally have done with my own money and how I have repositioned. This is not financial advice. This is what I personally did when I came back from Zurich and Singapore. I am sharing it because I believe in transparency. I believe you deserve to see the logic, not just the conclusion. You must do your own research and consult your own advisors before making any changes to your own portfolio. Action 1. I moved 15% of my total portfolio into physical gold and gold-backed ETFs. Specifically, I used IAU and GLD, which are two of the largest and most liquid gold ETFs available through any standard brokerage account. These are not exotic instruments. These are the instruments that the people who understand the mechanism use to protect themselves. Physical gold holds value across currency transitions. It held value through the collapse of the guilder. It held value through the collapse of the pound. It held value through the 1971 dollar shock. It is holding value right now as central banks buy it at the fastest rate in 50 years. I did not put all my money into gold. I moved 15%. That is a meaningful allocation without over-concentrating. Action 2. I reduced my U.S. stock exposure from approximately 80% of my equity portfolio down to 55%. The 35 times earnings valuation on U.S. stocks is a number I cannot ignore. When Goldman Sachs projects 3% annual returns over the next decade, that is not pessimism. That is math. I did not move into cash. I moved the freed-up allocation into international equities, specifically using VXUS, which is the Vanguard Total International Stock ETF. International stocks are trading at roughly 12 to 15 times earnings compared to 35 times in the U.S. The same global economic growth can produce very different returns depending on where you start from a valuation standpoint. I moved 25% of my equity allocation into VXUS. Action 3. I built a position in inflation-protected bonds, specifically TIPS, which are Treasury inflation-protected securities. When prices go up, the value of TIPS goes up with them. They are not glamorous. They are not going to make you rich quickly. But when your grocery bill is rising 25% over 5 years, having a portion of your fixed income tied to actual inflation rather than a fixed rate is the difference between keeping up and falling behind. I moved 10% of my fixed income allocation into TIP, which is the iShares TIPS bond ETF. Action 4. I added a small allocation to energy, specifically VDE, which is the Vanguard Energy ETF. Energy is real. Oil is priced in dollars today. But as the petrodollar system weakens, energy companies that produce real commodities maintain pricing power across currency regimes. I moved 5% of my total portfolio into VDE. Energy is not a speculation for me. It is a hedge against the weakening of paper currencies. Action 5. I diversified outside the US dollar entirely for 10% of my liquid savings. I did this through a combination of Swiss franc-denominated assets and by opening a small position in non-sovereign debt through international bond funds. This is the most unconventional step I took, and it is the one that the people in that room in Zurich were already doing for their clients. The idea is simple. If the dollar weakens against other currencies over the next decade, having 10% of your savings in non-dollar denominated assets acts as a natural counterbalance. These are not exotic instruments. These are the instruments that the people who understand the mechanism use to protect themselves. Let me bring this full circle. I opened this video by telling you that 80% of your money has already disappeared. I want to be precise about what I mean. It has not disappeared from your account. The number is still there, but the purchasing power behind that number has already eroded more than most people realize. Since 2020, the US dollar has lost more than 17% of its purchasing power. If you had $100,000 in savings in 2020, that money can now buy what $83,000 could buy 5 years ago. The number says 100,000, but the reality is 83,000 in purchasing terms. And this process is not stopping. The mechanism I described, the slow transition away from dollar dominance, the central bank gold buying, the reduction in U.S. Treasury holdings, the cracks in the petrodollar system, these are all accelerating, not collapsing. Accelerating. And the acceleration means the window to act is not indefinitely open. I have watched this pattern unfold across 3 major cycles in my lifetime. The people who moved early kept their wealth. The people who waited for certainty moved too late. I cannot tell you the exact date. Nobody can. I will never predict a specific date. But I can tell you that the evidence I saw in Zurich and Singapore, the unanimity of the people in those rooms, the data on central bank gold purchases, the shift in Treasury holdings, the valuation gap between U.S. and international stocks, all of it points to the same conclusion. The transition is not coming. It is already underway. And the question is not whether you will be affected. The question is whether you will be prepared. I have been doing this for 35 years. I have made mistakes. I told you about the worst one. I borrowed money I should not have borrowed. I was certain when I should have been cautious. And that mistake taught me the lesson that drives everything I do now. The most dangerous financial events never feel dangerous when they are happening. They feel like stability. They feel like the system is working. They feel like the people in charge have it under control. The dollar feels stable today. U.S. stocks feel strong today. The system feels intact today. And that is exactly the feeling that precedes the moment when the transition accelerates from slow to sudden. I am not saying panic. I am saying prepare. I am saying look at the numbers. Look at the valuations. Look at what the central banks are buying. Look at what the large capital allocators in Zurich and Singapore are doing with their own money. And then ask yourself, is the allocation in my own account positioned for the world as it was, or for the world as it is becoming? That is the only question that matters right now. And it is the question I want to leave with you today. If this video gave you something to think about, please subscribe. I read every single comment personally, and I want to ask you one specific question before you close this video. Look at your current portfolio or your retirement account. What percentage of it is currently in U.S. dollar-denominated assets? Not a long answer, just one number. Write it in the comments right now. Just the percentage. That number will tell you everything about how exposed you are to what I described today. Write your number below. I will read every single one.